Welcome to CoreLogic's housing market update for November 2020. Following 5 months of consistent declines in residential property values, CoreLogic's National Home Value Index moved back into positive month-on-month growth through October, posting a 0.4% rise. The lift in home values was broad-based, with every capital city apart from Melbourne posting a rise in values over the month. Dwelling values increased by more than 1% in each of the smallest 4 capital cities, with Brisbane, Adelaide, Hobart and Canberra housing values reaching a new record high. Although values were lower across Melbourne through October, the trend rate of decline has been easing since mid-September. With a drop of 0.2%, this was the smallest month-on-month fall in values since the COVID-related downturn commenced in April. The October results show early signs of a divergence between house and unit market performances. The rise in capital city housing values over the month was entirely attributable to a 0.4% lift in house values, which offset the 0.2% fall in unit values. Through the COVID period so far, unit values have actually shown a smaller decline in values than houses, but this is probably set to change. Almost 2/3 of Australian units are rented, and rental conditions have weakened, especially around the key inner-city precincts of Melbourne and Sydney. These areas have a high concentration of unit stock and historic exposure to demand from overseas migration. Low levels of investment activity, relatively high supply of unit stock in the inner cities, and international border closures are key factors that imply units will underperform relative to houses over the medium term. Regional housing markets continue to outperform the capital cities in October. Broadly, CoreLogic's combined regionals index has held relatively firm through the worst of the COVID-related downturn. The past 2 months have reversed the previous mild falls across the combined regional areas. In the 7 months since March, regional dwelling values are actually up 1.7%, while values across the combined capitals index have fallen by 2.3%. The newfound popularity of working from home is only one of the factors helping to support regional home prices. More affordable price points, lower densities, and lifestyle factors are also underpinning the relative strength across many of the regional areas of the country. The recent lift in home values coincides with a range of other indicators that have also improved over recent months. Consumer confidence has consistently improved since the virus curve has flattened, and Australians have responded positively to measures announced in the federal budget. In October, we saw a surge in consumer sentiment, rising clearance rates, and an increase in valuations for property purchases. Alongside this, we're also seeing persistently low advertised stock levels, which has also supported price growth. Despite a surge in new listing numbers, total advertised inventory levels remain close to record lows. The number of new listings added to the Australian housing market over the past 4 weeks rose by about 25%, while unit stock levels grew by less than 1%. Persistently low stock levels in the face of surging new listing numbers point to a strong rate of absorption as buyer demand exceeds advertised supply levels. Home sales were higher through October, with CoreLogic estimating a 7% rise in settled sales nationally over the month. Over the past 3 months, nationwide sales activity was roughly 1.5 times lower than what it was last year, weighed down by an 18% drop in sales across the Melbourne area over the same period. Auction results have been also strengthening, with CoreLogic consistently reporting clearance rates above 60% over the past 2 months. Sydney's clearance rate breached the 70% mark in late October for the first time since early March, and auction volumes have been at similar levels to last year. Melbourne, which is normally the largest auction market, saw the number of auctions held rise from virtually nothing in September to around 600 auctions by the final week of October. Rental market trends are showing a more significant divergence between houses and units. Between the end of March 2020 and October 2020, capital city unit rents are down a cumulative 4.8%, while houses have recorded a 0.4% rise in rents. Every capital city region has seen house rents either rise more than unit rents or fall by a smaller amount. The difference between house and unit rental performance is most significant in Melbourne and Sydney, where since March, unit rents are down by 6.6% and 5.8% respectively, while house rents have seen a more mild reduction of around 1%. The divergence in Sydney and Melbourne can be explained by a combination of supply and demand factors. Both cities have a multi-year history of significant supply additions to the high-rise unit sector, where the majority of properties are owned by investors. From the demand side, the evaporation of overseas migrants, including foreign students, has led to a sudden and material drop in the number of renters requiring accommodation. Additionally, weaker labour market conditions across industries where workers are more likely to rent than in any other sector have further impacted rental demand. Perth and Darwin stand out with the tightest rental market conditions. Both house and unit rents are up through the COVID period to date. The stronger rental conditions come after a long period of weakness in rental markets. Dwelling rents in Perth have only increased by 0.4% over the past 5 years, while in Darwin, rents are actually 11.4% lower than they were 5 years ago. The latest rise in rents can be attributed to the recent history of low private sector investment, which has kept rental supply low. In summary, it's clear that housing markets are responding to the stimulus of low mortgage rates and improved sentiment related to measures announced in the federal budget and the low number of new virus cases. Housing values are either rising or stabilising across each of the broad regions around the country. The volume of home sales is rising and inventory levels are generally being absorbed faster than the rate of new additions. Market activity is on the rise, with measures of real estate agent activity across CoreLogic's RP Data platform up 11.5% over the month, and the number of valuations for home purchasing across the Valex platform is 11.2% higher over the month. The announcement that interest rates have been cut even lower is likely to provide a further boost to housing activity. Record low mortgage rates are a key factor supporting the housing market. Historically, cuts to interest rates have fueled housing market activity and generally placed some upwards pressure on dwelling prices. With the trend in housing values already rising around most areas of the country, there's a good chance that lower rates could see momentum building across the nation's most valuable asset class. The recent housing market growth trajectory comes amidst the winding down of fiscal support programs such as JobKeeper and coinciding with a majority of home loan repayment deferrals expiring. So far, this period of uncertainty hasn't impacted on housing market performance. However, it will be important to monitor changes in inventory levels and vendor metrics at a geographically granular level, watching for any sign of distressed stock. The stimulus of such extremely low interest rates, together with the initiatives announced in the federal budget and state-level incentives like stamp duty concessions and building grants, are likely to be enough to outweigh the headwinds facing the market. Ultimately, we should get some clarity on how these opposing forces are playing out over the coming months. You can stay up to date on how the trends evolve at the CoreLogic research pages at www.corelogic.com.au.